Hello, everyone, and welcome to the quarterly investment call for the UTI India Dynamic Equity Fund. We're delighted to have you with us today. Let me run quickly through the agenda for today's call. An introduction and welcome by Shweta Rungta, Head of Products at UTI Investments. A macro update on India by Vetri Subramaniam, Chief Executive Officer Designate. This will be followed by a fund update from Ajay Tyagi, the portfolio manager of the fund who's been managing the fund since its inception. Before we begin, just a few housekeeping notes. Today's session is recorded and we'll conclude with the Q&A session. So feel free to submit your questions in the chat box at any time during the call. With this, let's get started. I'll hand over to Shweta for the opening remarks.
Thanks, Neha. Good morning, good afternoon, good evening, depending on wherever you're dialing in from. Thank you for joining us today. Let me start by addressing the current backdrop directly. India's had a rough start to the year. We've seen foreign investor outflows, some currency pressure, and US dollar returns that don't look great on a year to date basis. This is all very real and it's on every global allocator's dashboard. But this is also where framing matters. In markets, especially early in the year, there's a tendency to let short term USD performance drive big decisions. And that's often where mistakes happen. A lot of what's weighing on returns right now is capital flows and FX, not a breakdown in fundamentals. Historically, when India has gone through phases like these, where sentiment is driven more by currency moves and positioning than by earnings, it's tended to improve long-term opportunity set rather than weaken it. Why is that? Because in such times, valuations reset, positioning clears out, and expectations come down. From a fundamentals point of view, we are not seeing the usual signs of stress. Balance sheets still remain very healthy, earnings are still broad based, and domestic capital continues to play a stabilizing role. Having said that, volatility from here shouldn't be unusual, but that's part and parcel of investing in risk assets. So, the key in our view is to not let early year mark to market moves override a longer term assessment of fundamentals and forward returns. So, while the near term may remain noisy, our focus still stays firmly on fundamentals and forward returns. That perspective continues to shape how we are positioned and how we think about the road ahead. Thank you, and over to you, Neha.
Thank you, Shweta, for that wonderful overview. I'll now hand over to Vetri, who will walk us through the key macro trends that are shaping India's economy. Over to you, Vetri.
Thank you. Thank you, everybody, for joining us on this call today from wherever it is that you're dialing in. I think Neha set or rather Shweta set the stage up quite nicely. You could, look at India and talk about it in the context of being a glass half full or glass empty. It's really a question of perspective. I think the last 1 year is after a very long time. I've experienced something personally which I've not experienced for many years, which is for the first time, India has dramatically underperformed many emerging markets over almost, I would say, over the last 2 years. It is a significant underperformance. When I look back at my own investing career over the last, 25 years, 30 years, most, such periods, you've typically tended to see outperformance in India relative to other EMs. So I must say the last 18, 24 months are quite unusual in terms of India's underperformance relative to EMs. But if you look at it the other way, the glass is half full because now the valuation premium relative to the other EMs has completely come off. So at least the classical argument about India being rich is not as true as it used to be maybe 2 years ago. But let's jump into today's presentation and then, we'll be talking through some of these points anyway. So moving ahead to the, first sort of topic point for today where we'll talk about the macro trends. So this is a slide on inflation on the left-hand side, and on the right you can see GDP growth, both in terms of real growth and nominal growth. Now, these two charts are linked. They are linked in the sense that when you look at the left-hand side slide on inflation, the orange line is core CPI and the blue line is headline CPI. As you're familiar, India has articulated a policy going back to 2016 of targeting inflation in the range of 4 plus or minus 2% headline CPI. And when you look at that blue line, you can see that we've been quite comfortably within that boundary range for a while now. Core CPI is been a little bit more stickier than the ups and downs you see on headline CPI. But again, that is very well within the comfort zone of that 4 plus or minus 2%. There has been a reduction in headline inflation in India consistently going back to just before the pre-pandemic period. And what this has converted into on the right-hand side is that while India's nominal GDP, real GDP growth outcomes have tended to be in the 6.5, 7.5% range on average, the orange bars, which reflect the nominal GDP growth line, show a steadily declining trend. And the reason for this is India's success in being able to hold inflation down to a much lower level than what we used to earlier. So whereas earlier we used to talk about India's nominal growth being 12 to 14%, that does appear to have been a reset, perhaps to a 10 to 12% range, and maybe coming up closer to 10% for next year, but we'll talk more about that later. Moving on to the next slide. So we are talking about fiscal discipline. The reason for that is very simple. On Sunday, February 1, the Indian government will present its fiscal accounts for the coming year, which is April 26 to March 2027. By the way, that's a Sunday, but all the same, Parliament will be working and the equity market will also be working. So there's going to be some amount of excitement on a Sunday relative to markets, which otherwise normally doesn't happen. Now, if you look at the left-hand side, what you'll realize is that the discourse in India in recent years has all been around capex growth. So the left-hand side chart shows you the growth in nominal GDP, the growth in tax revenues, the growth in capex, and then finally the growth in revenue expenditure. And you'll see that just sort of going into the pandemic, Government of India starts to press the pedal on capital expenditure, which is why those orange bars are the strongest set of bars through this entire period, because Government of India really sort of did what it could to drive capex higher. Coming into 2025, you'll see that capex growth finally slowed down to below that of nominal GDP growth. The 26 number is likely to look similar, and we don't expect a very big change in 27 either. So there is this binary of, will the government choose to support capital expenditure or revenue expenditure? Our sense is, given the need to manage the fiscal deficit, and the government has actually now moved to target debt to GDP rather than fiscal deficit on an annual basis, the big message is really that fiscal discipline is likely to continue. India is now currently at a debt to GDP, central government debt to GDP of about 55%. The government wants to drop this to 50% by 2030, which means in our estimate, once you crunch the numbers, they will have to continue to guide down the fiscal deficit from 4.4% this year, closer to 4%, presuming nominal growth rate of the economy stays at 10%. So I know we've said fiscal discipline to continue question mark, but our base case is that they will continue to stay disciplined, and you're unlikely to see capex play as much of a stellar role in government expenditure as it did during the period 20 to 2024. It's likely to be more subdued, and even on revenue expenditure, things are likely to be subdued, because remember, indirectly the government has already supported households, one by way of an income tax cut in 2025 budget, and secondly by the GST cut which happened, the goods and sales tax cut which happened in October 2025. So this ties the hands down in terms of revenues for the government and therefore even their expenditure, and we think fiscal discipline is the trajectory India will continue to follow. On the next slide, as we move on, a little bit of conversation on India's imports and exports. And you can see over there the calendar year numbers for imports and exports. What you'll notice is that even despite the US reciprocal tariffs in April 2025, followed by a further penal duty of 25% on Indian exports in August 2025, India's exports calendar year 25 and 24 look broadly similar. Yes, it's not grown, but at the same time, no visible impact on aggregate exports of the tariff standoff with the US. Gold imports, on the other hand, you can see on the right hand side, slightly higher in 2025 as compared to 2024. What does this mean? It means that gold value imports into India have stayed unchanged. So volumes have come down because remember, prices of gold have been significantly higher through 2025. So the Indian appetite for gold, at least in dollar terms, has not reduced, even though in volume terms it has seen a decline. That's the way we've managed our import-export balance through the year. There's been some pressure on the import side because gold, imports have not cooled off as much as one might have hoped for, but we got some benefit because oil prices were lower, and overall the trade deficit still remains in what I would say a reasonably comfortable zone relative to India's history. You can see all the numbers in this slide going back to 2020, and you'll find that the numbers are more or less tracking at the same level relative to GDP growth, to total GDP. Moving on to the next slide. This talks about the Indian forex movement. Now, the USD has depreciated, the US dollar has depreciated against a basket of most global currencies. We've plotted here for the USD DXY. So this is plotting it relative to the euro, the British pound, yen, Canadian dollar, and of course the Swiss franc. And it is, disappointing to see that even though the dollar has been weak, the rupee has continued to remain weak relative to most global currencies other than the yen and USD. Multiple reasons for this. It has not benefited from the tailwind that many other EM currencies or other developed currencies have benefited from. It's depreciated across the board. Some of this we think has got to do with unfavorable balance of payments coming from net FDI in India being quite weak during the last 2 years, because foreigners have actually withdrawn money from the market, both through the FPI route as well as, remember, we've had some large companies choosing to list in India, which has amounted to the foreign shareholders selling down shares and listing companies like Hyundai, LG, GE, etc. in India, as a result of which FDI has actually flown out and net FDI has been weak in India. So that's perhaps one reason why the Indian rupee's trajectory is slightly different from what we've seen in other EM currencies. But having corrected significantly, we do think, Indian forex is more attractive in relative terms today, given the underperformance that has now happened. Moving on to the next slide. I just wanted to sort of put in context a lot of what we have seen over the last, I would say, roughly 12 months, both in terms of monetary measures by the Reserve Bank of India or the Monetary Policy Committee, and secondly by Government of India, a combination of both fiscal and structural measures. All of these measures put together amount to significant monetary easing, either by way of policy rate cuts or changes in rules related to lending, which eventually means that the central bank is now more supportive of higher credit growth within the economy. On the other side, Government of India has stayed on the path of fiscal discipline, but has taken significant number of administrative measures, including liberalization of FDI, customs duty rationalization, labor reforms, insolvency and bankruptcy code being streamlined further, and finally a series of trade deals which have concluded with regions such as UK, Oman, New Zealand, and of course the big one happened earlier this week, which is with the EU. So there have been a host of economic reforms which have taken place over the last 12 months by Government of India. You combine them with the monetary measures and the pro-growth measures taken by the central bank in terms of monetary policy and of course by the Monetary Policy Committee. I think it creates a very positive backdrop both in terms of cyclical and structural factors. Moving on to the next slide. So here we are talking now, or we're starting to now move to talk more about earnings growth. March 26 estimated earnings growth 8% hasn't changed too much from the last time we spoke. The bar for March 27 is quite high, 17% earnings growth. And we'll talk more about what we think about this number going ahead. Moving on to the next slide. Now, if you look at India in the context of 2-year growth expectations, and we are looking at 2-year to sort of normalize some of the cyclical impacts, what you'll see on this slide is that the current analyst estimates for 2-year growth estimates from India are still pretty much top of the pack, or certainly among the top quartile of earnings growth expectations. This is a select list of EM economies, but as you can see over here, India's 2-year growth expectations at 15% are quite healthy at this point of time. We can talk about the risk to earnings estimates later. Moving on from that to the next slide. There has been a moderation in earnings growth. You can see this trend line of revenue growth and profit after tax growth for the top 500 companies in India. What percentage of the 500 companies are growing faster than 10% year on year? In 2024, 60% of the companies were growing faster than 10% year on year in terms of revenue, 55% in terms of profit growth. That number has declined closer to about 50% at this point of time. But going into 27, the outlook is slightly better for revenue growth acceleration, because we think nominal GDP growth is likely to get a bump up as both inflation and policies have turned more supportive. Yeah, we can go on to the next slide now. So now we are talking about the valuations. This is the Nifty 50. Nifty 50 top 50 companies in India effectively reflects the valuations of large cap companies in the country. And as you can see, both on a trailing PE basis, it's in the fair value zone, which is in the white zone. On forward PE basis, it's in the slightly expensive zone at the end of December, but keeping into account the recent sort of correction which has happened, I would submit that this is also pretty much now kissing the borderline of fairly valued and expensive. So after a long time, the Indian market is sort of trading in the fair value as far as the trailing and forward PE multiples are concerned. That's a function of the 2-year underperformance of Indian equities. On the next slide, we can see the price to book multiple. This, of course, is very comfortably placed within the white zone, which is the fairly valued zone. Here we are looking at the Nifty 50 relative to its own history. So this is certainly showing the market to be at a reasonable level of valuation reflective of large caps. What does the picture look like for mid caps and small caps? You'll see that on the next slide. Here, I'm afraid the situation still remains that the market is quite expensive in terms of mid caps and small caps. You can see over there, they are both trading at a premium to the large caps. And in addition to that, they are trading in the expensive zone relative to their own history. So we would continue to be, sort of cautious from a top-down perspective on mid caps and small caps, purely from a valuation perspective. Moving on from that to the next slide. This shows you the longer term shift which is happening in the marketplace. This is the entire market cap of the Nifty 500 companies broken up into large cap, mid cap, small cap. As the number of listings in India has increased, a lot more of those companies are listed as mid caps and small caps, and they've tended to trade at a premium to large caps. As a result of which, on this chart, which is 15-year data, the share of large caps in aggregate market cap is now at the lowest we've seen in the last 15 years. I will, however, say that this is not necessarily a mean reverting chart, but again, there are always cycles in every data point that we see. And when you look at this number where large caps are at their lowest as a share of market cap of the top 500 companies, it's a reflection partly of the buoyancy in new listings and equally the higher valuations in mid caps and small caps. So while I don't have a mean number to which this can revert, the risk reward would seem to be more favorable for large caps. Moving on from this to the next slide. There's been a little bit of a stealth bear market in India. If you look at the left-hand side, this is index level data. So how much down is the Nifty 100 from its all-time high? This is data as of 9th of January. The Nifty 100 top 100 companies are down 2% from their 52-week high. You come down to the Nifty small cap 250, it's down 8% from the 52-week high. But when you look at the median fall for the Nifty 500 companies, that is 18%, which means more than 250 companies in the Nifty 250, in the Nifty 500 have fallen more than 18% from their peak. And if you look at what percentage of companies are down more than 30% from their peak, 21% of the companies are down more than 30% from their peak. So I would say in this cycle, the indices have been a little bit deceptive. The cuts which have happened in individual stocks has been far more pronounced. This is slightly different from the data you see on the right side. This is not data from all previous cycles in India, but just comparing current data to what it looked like in 31st December 2018, when we were about 12 months into a drawdown. At that point of time, you can see that the cuts were visible far more accurately, both in the indices and at the median level. So this time so far, the cut is visible more in the lower market capitalization part of the market, not so much in the top end companies. So we'll move on from that. As a result of everything that we've talked about, you've seen how India's valuations have corrected relative to their own history. What's happened to India's valuation relative to emerging markets and developed markets? You can see this on the left and right hand side. So India's forward PE relative to emerging markets, which was always at a premium, that premium expanded to almost 100% premium in 2022. Now it has come back quite close to the long-term average, which is a 60% premium to the EMs. How does India's multiple compare to developed markets? Again, we've trended at a premium for a very long time to developed markets. Currently, we have pivoted to trading at a discount to developed markets. On the next slide, you'll also look at the price to book ratio relative to EMs. Here, in fact, we have now dropped to a discount on price to book relative to the historical premium we've enjoyed to emerging markets, which is to say our premium to emerging markets on price to book has typically been 80%. We are now less than 80% premium, so we are less than our average. But of course, we are still at a premium to other EMs, which is, to my opinion, also a function of our superior ROE and the superior long-term growth runway. So moving on from that, this is the asset allocation framework. May not bear relevance to many of the investors on this call today, but this is what we sort of indicate to investors looking for a toolkit in India to think about what are the favorable times for investing in equity, when are the probabilities more favorable, and when are the probabilities unfavorable. So when you look at this, what you will see is that the black line is currently in the middle, which is the fair value zone for investing after having been in the decreased equity allocation zone in 2024 and then, of course, again in 2021. Now, this indicator is based on price to earnings, price to book, dividend yield, and also a comparison of equity yields to bond yields. So this is a multivariable model that we use to signal our bias in terms of asset allocation. And this is currently positing that equity valuations in India are in the fair value. One caveat: we are only using long-term valuations in this model of large cap companies. So this model is not indicating the attractiveness of mid caps and small caps. It is only indicating what the data for large caps already indicated, that large caps are now in the fair value zone, whereas mid caps and small caps, our top-down asset allocation view would still be negative. Just on the next slide, you'll see what are the probabilities associated with such zones. So if you look at the middle zone, which is where the market currently stands, fair value for equity investing, when you look back at the data, which goes back almost 15, 20 years, the 1 year returns for this bucket are on average plus 12%. The deviation is quite significant. It's generated a minus 31% at the worst return, plus 44% as the best return. The 1-year return has been negative only 19% of the time. But what really makes the odds favorable for India today is that the 1-year return being higher than 12% has happened 52% of the time when the market has traded in this yellow zone. So which is why we think now the odds are in favor of investors with a 1-year plus horizon, and that's what the data is suggesting in terms of India. And it's a function of both absolute valuation as well as the relative valuation charts that I showed you. So finally, moving on to sort of my summary slide, global growth trends are still mixed. US growth is really the standout. India's macro fundamentals are in great shape. Fiscal and monetary policy are both supportive. I would say even the government's reform agenda has been very supportive, whether it is liberalization of FDI, expansion of foreign trade agreements, the new labor codes. We talked about all of these. All of these are long-term positive supply side measures to enable India to grow faster and stronger. We think there will be a nominal GDP growth acceleration in 2027, both because of a pickup in activity from the pro-cyclical stance of government and monetary policy, as well as the rise in inflation. Earnings growth consensus expectations for March 27 is 17%. Arguably, that is still a fairly high bar. So there is perhaps some, healthy skepticism we have towards that 17% number. But India's valuation premium is now in line with historical premium. Our equity valuation index, which is the 4-factor model I talked about, is in the fair value for equity zone investing. And that gives us a lot more relative comforts as far as Indian equities are concerned. So that's about it for a macro wrap. I'll pause at this time and hand it back to Neha. And Neha, you can take it from here.
Thank you, Vetri, for this very comprehensive and insightful perspective on the macro environment. I'll now invite Ajay to take us through the fund update and portfolio positioning. Over to you, Ajay.
Thanks, Neha, and thanks, Vetri, for talking about the economic backdrop and the markets. So let's start with the update on the fund, and we will once again refresh our investment philosophy, which is basically predicated around buying high quality businesses which show strong cash flow, strong return on capital, and also have a long growth runway in front of them to reinvest these cash flows. So that's been our philosophy since inception. Of course, as I'll show you in the subsequent slides, growth hasn't really been the area of interest for investors in India. In fact, growth continues to underperform value, basis which we've also seen underperformance over the last few years. Moving on, let's look at the performance of our strategy since inception at the top from a calendar year perspective and on a rolling basis at the bottom. So to start with, 2025 on the top table, right-hand side has been a challenging year once again. We underperformed, the MSCI India last year, and our performance since 2022 has actually been bit under the weather, and that's why over a 3 and 5 year perspective, you see the strategy underperforming. However, what we also do is track the portfolio in terms of its fundamental, vectors in terms of sales growth, profit growth, return on capital, also in terms of the cash generating ability of the portfolio. When we track this portfolio versus the benchmark, which is MSCI, we realize that the gap that we have actually felt all through the last 15 years is still pretty much there. So the portfolio is still growing 4 to 5 percentage points higher than the benchmark. The portfolio's profit is also growing with the same difference compared to the benchmark. Portfolio's return on capital is about 10 percentage points higher than the benchmark, and cash generating ability is also significantly higher. So on the core vectors, the portfolio continues to do well, but unfortunately, quality has not been in favor for the last few years, which I'll show you in the subsequent slides, and that's basically continued to hurt us. Let's move on And let's now look at basically what has worked for us over the last 1 year. The Indian government, as you're aware, did actually rationalize the indirect tax rates, or the GST, as it's known here, the goods and services tax. And while they were rationalizing these tax rates, one clear beneficiary was the auto sector, particularly the auto OEs. And our overweight position has helped us. More particularly, two stocks, Maruti and Eicher, have actually done very well, and that's within financial services. Few of the banks that we've been holding for long and up until 2024 did well last year. That helped us. No exposure to low growth companies like TCS, like HCL Technologies, and ITC have also helped the performance. In terms of key detractors, our overweight stance on consumer services has hurt us. Consumer consumption in general has actually remained weak over the last few years. We have reasons to believe that consumption should come back. At the beginning of last year, during the budget, the government announced a cut in direct tax rates, that is the income tax rates. And that led to about 11 to 12 billion dollars being released for households in terms of additional disposable income. In October of last year, when GST was being rationalized, and in general rates were being brought down across different sectors, at the aggregate level, about $22 billion would be the overall savings and therefore increase in disposable income for households. So we're talking about numbers which are around $35 billion, give or take, which is a fairly large number for a $4 trillion economy. And while consumption trends have been fast, we that in the future consumption should remain strong. So while some of our consumption companies have disappointed us in terms of their stock price movement, but we continue to remain convinced about their future prospects. We have also had underperformance in the healthcare sector, and I would say that we've had a few wrong decisions in the portfolio. So that's more stock specific rather than the sector as a whole, and we are in a corrective mode already. We move on to the next slide. So as is customary, we will give you two quick examples of companies in our portfolio. Let's start with Eternal, which is a fairly large size position in the fund now. It's part of the top 3 holdings in the fund. We've been invested in this company since 2021, but over the last 4 years, we've gradually increased exposure from about 1% to more than 5% now. It has 2 lines of businesses. It started as a food services company, which is where it still derives majority of its profits and cash flows from. Food services has already become a $5 billion GOV business for them. With very steady and sharp margins of 5%, it's a duopoly, so there is immense pricing power, and Zomato holds almost a 60% market share here. But the big movement in the stock price over the last couple of years has been on account of its quick commerce venture, which basically essentially delivery at your doorstep in about 10 to 15 minutes. And I think this is the adjacency which led to an absolutely unexpected new profit stream, revenue stream, of course, and then profit stream coming in. And that's led to a massive re-rating. Here again, the company is a number one, and a number one by a huge distance, by a huge mile, I would say, both in terms of its market share, but more importantly, in terms of its profit share and the fact that it is the only company which is breaking even, whereas all other companies are making huge losses. This is an opportunity much larger than food services. Obviously, groceries are a much bigger item in any economy compared to out-of-home food consumption, and that's why we remain excited about this company and its prospects. We can move to the next slide, and as you can see here, on the top right-hand side, the growth in the food services business, with the blue line showing you the contribution margin. On the bottom left-hand side, you see the massive exponential growth in the quick commerce business, but also importantly, once again, the blue line, which is contribution margins, which are rising every year. And we hope that the next financial year itself, which is the financial year starting April of 2026, the company should actually have a slight profit at the EBITDA level itself. So, we remain convinced about the prospects of this company. Of course, as you can appreciate, high growth companies do see volatility from one year to the other. So, this is one of those stocks which has been prone to massive volatility over the last 3-4 years. But our North Star here is the absolute potential food services, which by the way is still underpenetrated in India, and the massive runway in front of the quick commerce. Both cases, the company is either massively profitable or already breaking even. We move on to the next example, which is InfoEdge. By the way, InfoEdge is also the largest shareholder of Eternal. It invested way back in 2009 into Eternal, but we haven't, put InfoEdge here to, discuss about its success into investing into early stage companies like Eternal. But InfoEdge remains a very solid business in terms of its operational domain. It basically is a classifieds player which derives majority of its profits right now from the recruitment vertical. This is one of those verticals where it's shown almost close to 20% growth in revenues as well as profits over the last 15 years. Continues to command a massive market share of around 65%. All the other market players are fairly distant in terms of their shares. But the interesting story here is that it is also the number one player into real estate classifieds. It owns the real estate classified called, it owns and operates a real estate classified called 99 Acres. And as we all know that the real estate market in any economy is always larger than the recruitment market. And this is one, vertical where the company is showing steady growth. It still is not profitable, but our hope is that, like the recruitment business, here again, the company will continue improving its profitability as the size increases. On the next slide, you can see the progress in both of these verticals. On the top right-hand side, you see the growth in the recruitment vertical over the last 10 years and also the steady improvement in margins. These are typically winner take all businesses, and platform businesses do have the ability to continue increasing their margins. The EBITDA margins for the recruitment business are a crazy 58%. For the real estate vertical on the bottom left, while you do see steady growth over the years, but the profitability levels have still not reached. The company is still very close to the break even, but not breaking even yet. But this is now reduced to just a three-player market, with the third player being very small, but the second player being just about 10% lower than 99 Acres on a market share basis. But it's our belief that sooner rather than later, this business too shall become profitable. And like I said, it's one of those verticals which has a much bigger potential compared to the recruitments vertical. We move on and let's look at the portfolio in terms of our sectoral allocation. Not much change between now and same time last year. Clearly, what has hurt us at the bottom, if you see, is the solid performance in the metal sector where we don't own anything. The relatively better performance in utilities and also in energy companies in India. So that's clearly, a big source of our underperformance. But our reason of being underweight or not having any, kind of investments into company sectors is because of the cyclical nature of growth and also return on capital and profit very low across companies in these sectors. We move on to the next slide where we have the full portfolio. Once again, not much change here. Of course, there is a reshuffle amongst the top 15 names because of the mark-to-market movements, but we haven't rotated the portfolio a whole lot. The portfolio turnover still remains about 10 to 12%. We obviously are looking at adding new names, and this year, once again, over the last 1 year, we did add new names like Affle, which is the largest player in digital advertising in India. We also added another auto player called Mahindra and Mahindra, which is, by the way, the third largest, passenger car manufacturer in the country. So yes, we do make some additions in the portfolio every year, but we don't move around and swing the portfolio a whole lot. Yeah, moving on. A quick discussion about our ESG credentials. As you all are aware, we are an Article 8 fund under SFDR. We thought, we should introduce a case study, of some of the engagements that we're doing with our company. So on the next slide, you see our engagement with, the management and the auditors of Polycab India, which is India's largest wires and cables manufacturer. In Jan of 2024, there was news around the income tax department conducting a search and seizure operation on this company, which resulted into a single day fall of about 20%. Our immediate reaction was to engage with the management, but we went beyond that. We also wrote to the audit committee of the company, the chairman of the audit committee of the company, and urged them to have a independent and impartial inquiry about these. We also separately engaged, with the auditors, but also the ecosystem, some of their suppliers to, gauge about their, processes and so on. We end of this exercise, we were fairly convinced, but around the same time, the company also made a disclosure to the exchanges that these operations, these search and seizure operations by the income tax department are not going to have any material financial impact on them. And we did gain confidence about the fact that there has been no wrongdoing in terms of bookkeeping or in terms of evading taxes. And that actually led us to increasing exposure in this company. Yeah. I move on to my last couple of slides. Like I had stated upfront, unfortunately, we are continuing to face headwinds in terms of how the quality style has been doing in India right from 2021. While there were signs of some reversal in 2024, unfortunately, the last 6 months have once again swung the needle completely in favor of the value style, which has now been doing exceedingly well for the 5th year running. That's led to performance headwinds for us starting off October of last year. And that's actually changed our performance from a 1 year perspective as well. But despite this strong underperformance of quality versus value, as you can see on the next slide, the big picture in terms of the 20-year performance of the quality factor, despite the last 5 years being so weak, is fairly heartening. As you can see on the extreme right columns, the two columns on the extreme right in orange, over a 20-year period, quality still outperforms value, and of course, MSCI India as well, and with a much less volatility. So what's giving us hope are two things. Number one, I did mention that while we do look at our performance from time to time, but more importantly, we look at the health of our underlying portfolio in terms of key fundamental factors like sales and profit growth, return on capital, whether margins are being defended, whether cash flows are steady or not, and whether the debt to equity position of our companies is also remaining strong or not. And that's where, the outperformance of our portfolio against the index continues unabated. We are hoping for the pivot to once again start moving towards the quality factor, which can lead to, an outsized performance in the coming years to basically compensate for the underperformance of the last few years. So with that, I would end my part of the presentation. I think, Neha, back to you for Q&A.
Thank you, Ajay, for that insightful deep dive in such a short time. Really appreciate the clarity and the details. Let's now open the floor to questions. I already see a couple of questions coming in through the chat box, so we'll try to address as many as possible. The first question appears to be for you, Vetri. Which Indian macro variables are you currently monitoring more closely? Inflation, interest rate, capex, credit? In that context, what behavior do you expect from INR going forward, and is there anything to worry?
Ooh, that's a lot of variables loaded into a single question, Neha. Maybe I'll have to create a new 4-factor model like we discussed on equity valuations to answer that. But let me put it this way. I think often what I have always found is the best, I won't call it a leading indicator, but a concurrent indicator of a growth revival and also a strong revenue outlook has actually been credit growth. Because credit growth numbers are practically available every fortnight for the banking sector, and that gives you a very quick ability to judge which way credit is flowing. And it's concurrent because it's both a driver of the economy, as well as obviously when there is a certain level of nominal growth which is happening, credit needs to rise to be able to support that. The good news is that there was a period where credit growth in India had gone down to a year-on-year single-digit basis, which is actually a constraint on the growth of the economy. But that number has now moved up to almost, low teens in terms of year-on-year performance of credit growth. So if there's one number that I would continue to watch to sort of give me a sense that all the monetary easing, the monetary measures that have been taken, which are more pro-growth, the fiscal measures that have been taken to simplify policy, supply side measures to sort of encourage more capital formation, all of that would eventually just translate into looking at that credit growth number move up. So if there's one number that I would watch, it would be that number. Inflation, you can never say it's always fully under control, but I don't think that's really a pain point that one needs to watch out for right now. To my mind, credit growth is what will indicate the health of the economy in terms of growth. And I think as you get greater confidence in growth, that should also cause the balance of payment to start looking better as you see a inflow of foreign capital, both as a function of the fiscal measures that have been taken, as well as generally a more positive growth outlook being a magnet for capital flowing in. I think that should help stabilize the currency. So if I were to watch one, that would really be credit growth. Private capex, etc., is too much of a lagging indicator. You don't get the numbers till too late. So they are good to analyze post facto, but they are not a concurrent indicator of where the economy is.
Thank you, Vetri. Maybe just building on that, we have another question which says, what are the capex mostly on for India before it slowed in 2025?
So I'd say it was across a range of factors, and particularly if you are referring to the capex growth that was coming in some of those slides which I had shown you, which related to government capex. A lot of the government capex is driven by hard infrastructure assets, and remember, government capex is primarily consolidated around areas like roads, railways, airports, those kind of things, power sector. A lot of that falls within the domain of government, and that is where we actually saw the big step up in capital expenditure. And government has been telling us two things. One, that they used the pandemic. Their response to the pandemic was fiscal support by way of capex rather than putting money in the hands of people. Having executed that over 3 to 4 years, they don't see any wisdom in continuing that policy aggressively. Secondly, because the remit of capex is limited in terms of the sectors where government can get involved, they didn't really see any shovel-ready projects to which they could allocate further capital expenditure. They are continuing to allocate some fiscal support, which shows up in the capex numbers, which is more in the nature of the production-linked incentives, which is supporting manufacturing efforts in multiple sectors. Electronics, Apple is the most well talked about story, but it's also there in pharmaceuticals, it's there in chemicals. And in fact, in the last year and a half, a lot of the announced capital expenditure support programs, whether they are PLI related or they are called PLI or not, are actually targeting the area of semiconductors and fabs. So that's where the government has been a lot more active in terms of directing its capital expenditure budgets.
Thank you, Vetri. Ajay, you may want to take this one. Are valuations now in a more comfortable zone? And just to build on that, are you worried about EPS evolution? Estimates are being revised downwards.
So, Neha, Vetri did show a few slides on valuations. Clearly, valuations are becoming more tenable. Yes, for the mid and small cap part of the market, we still feel that we are some distance away, from valuations turning favorable. But for the large caps, we seem to be very close, or we already are in the fair valuation zone, and we seem to be fairly close to our long range valuations. But the other interesting thing is when you compare India to either developed markets, where we clearly have gone below our long term averages, making the case for India attractive once again. And secondly, India's premium to all other emerging markets has now returned back once again to its long term, had gone significantly higher than long-term averages. So I think from a global context, we've returned back to where our long-term averages were, or perhaps even lower than that. From from the perspective of within India, what is attractive versus what is still not so attractive? Clearly, the mid and small caps are still not very attractive. From an earnings perspective, I did mention the measures taken by the government to pump prime consumption in India, and do remember that consumption is around 65% of India's GDP. So any effort to push consumption certainly would have an impact on overall growth and therefore earnings for the markets. And this is where we feel that in the upcoming year, FY27, we will move into double-digit earnings growth from the high single-digit number that we were tracking over the last couple of years. Yeah.
Thank you, Ajay. Vetri, maybe for you, the next question. How is India placed amidst current global instability, and what specific impact are US trade tariffs having on the Indian economy? And in that context, does the recent India EU trade agreement strategically bolster India's position?
Good question, Neha. Well, first of all, on the US tariffs, look, if you look at that data, if you remember the slide I showed you on export performance, there's literally no impact in India's total exports, year on year, which suggests that, that 50 odd billion, which is what was tariff impacted by US tariffs, has not impacted India too much. I think producers have found a way to, access markets perhaps through different routes, or maybe they have moved to different markets altogether. So as of now, does not seem to be any significant impact of the US tariff. But from a sentiment point of view, it's obviously an uncomfortable place to be in, because there is a standoff between these two countries who've been very strong strategic partners and allies for the last decade or more. So that's really something which I think is more sentimental rather than showing up in the numbers. Without doubt, however, Neha, I would say one of the things which has been very visible is the coordinated actions of the government, I would say, particularly through 2025. And I think some of this is certainly reflecting a need for India to, position itself, just giving the changing sort of geopolitical environment. Remember, going back almost 4, 5 or 6 months, after almost a 5-year pause, India and China started to finally normalize their policy vis-a-vis each other, because for 5 years the countries just weren't even talking to each other after the border standoff of 2020. Flights have resumed, visa issuance to citizens of the other countries has resumed, and in a limited way, business and commerce, including FDI, has also started to resume. As far as commerce is concerned, remember, there was never any shutdown as far as business to and fro with China was concerned. China remains India's #1 trading partner even through the last 5 years. So in that sense, I would say India has been embarking on a policy of normalization. We've seen this big trade agreement with the EU. This trade agreement with EU was first discussed 20 years ago, believe it or not. And then it sort of went into deep freeze for almost 5 or 6 years. And then, of course, in 2024, the conversation picked up again. But I think the speed at which it eventually got sealed in the last 5 months is just a reflection of the fact that all parties, be it India or be it the EU, are increasingly feeling the need to, start to put bilateral relationships in place, find those areas where you can work together, find the common ground rather than highlight the differences. So I would say India's policy very visible through 2025 has essentially been this: how does India create optionalities? How does India create choices for itself in a world where the multilateral system has effectively broken down? And that's visible in the series of bilateral arrangements that have been created by India, including the one with the EU. Remember, the EU is effectively India's third largest market for exports, and you could say it is the second because the second market I'm talking about is Asia as one combined destination, but Asia has many countries. So Europe is really our largest export destination after the US, and I think it's wonderful that this trade agreement is in place. It's a win-win for both countries. Anywhere between 95 to 97% of the tariff lines are getting covered by this agreement. The only thing which has been excluded from the purview of the trade agreement is the sensitive stuff related to agriculture, dairy. But outside of that, I think this is a landmark agreement between India and the EU, and I think this is something which will do the country and the EU, set in place a framework for a very symbiotic trade relationship.
Thank you, Vetri. The next question may be for you, Ajay. Could you please give us more color on risk management, especially when positions in the fund like Trent, Dixon lose more than 20%? How the team is addressing the investment case? Are positions increased?
Sure. So this is a very interesting question. I would say, look, we don't have any stop loss risk management tool to react to the fall in stock prices. But yes, any fall in stock price to the magnitude of what you just mentioned, of course, triggers a deeper check into our hypothesis just to see that are we on the right track? Are we missing out on something because of which the market is reacting? Or is it just one of those reactions because of a bad quarter or a bad couple of quarters back to back? So, you've taken the example of two companies, Dixon and Trent. It obviously has led us to once again go and test our hypothesis and see whether we are on the right track, whether the big picture is still valid, whether the businesses are seeing any deterioration in their operating metrics, or things are as strong as they were supposed to be. And whenever we come back convinced that this is more of a transitory problem, more of a couple of quarter problems, we go out and increase exposure. So for instance, whether it's Eternal or Dixon, we've clearly increased exposure over the last 3-4 months, and to an extent also Trend. But certainly much additions have been made into some of the names like Eternal and Dixon. Yeah.
Thank you, Ajay. The next question may be for you, Vetri, more macro related. Given that fundamentals remain supportive, inflation is low, interest rates are easing, and GDP growth remains resilient, how do you explain the relentless foreign portfolio outflows we are seeing?
So interesting question. I think it comes back to that, glass half full, glass half empty. I think FPI flows have certainly been, virulently negative. I think a lot of this has just got to do with the fact that, India, as I think Ajay and I have most probably espoused this multiple times over the last 2 years. The market in India has just been quite expensive relative to its own history and relative to other markets, and I think that's where the underperformance has finally kicked in, and the flows are merely a reflection of how that capital has flowed in the hands of capital allocators to other markets during this period. Obviously, during this period, we have seen domestic money remain very supportive of Indian equities. I think that is more a structural trend in terms of that bid, because Indians have been underexposed to financial assets, and I think the democratization of financial savings that we are seeing is something that will continue pumping in those kind of flows. So relentless selling, yes, but keep in mind that this was a market which had benefited from foreign flows for many years when other EMs were, actually experiencing declines. So I think it's just a little bit of what goes around comes around, and you've seen India sort of work through some of its valuation excesses. And I think, once that's stabilized, you will start to see a little bit more normalcy in terms of capital flows into India. But I would say eventually, Neha, it all always flows from where are the valuations and which way are the fundamentals shaping. I think when those shape up in the right direction, the flows follow. The flows always follow the fundamentals and not the other way around.
Thanks, Vetri. Maybe in the interest of time, we'll take one last question for you, Ajay. How do you assess the impact of fiscal policy on infrastructure spending and consumption?
In a way, Vetri answered this question in his presentation. Point number one is that the country is committed to fiscal discipline, which basically means that they will continue following the fiscal glide path, possibly, and we will hear this from the finance minister 2 days from now. Possibly, we may see fiscal deficit to be slightly lower compared to the fiscal deficit for the current year. Which basically means that the room for fiscal expansion is very, very limited. We are talking about the first year where the full impact for income tax GST cuts would be visible. That anyway is going to lead to pressure on the income statement for the government. In any case, like I said, maybe a slight fiscal tightening can be expected. And therefore, the government will have to be very, very conscious about where are they spending their rupee. Like Vetri said, it's our belief that they may take their foot off the infrastructure pedal, if not completely, but gently. That means incremental spend towards infrastructure will remain poor, while we will see growth in spends or at the absolute level, but those growth numbers will certainly be lower than what we saw between 2020 to 2024. At the same time, very clearly, the intent is to push consumption in the by way of these cuts that have happened. And I did, say that these cuts at an aggregate level amount to $35 billion. I also wish to state here very quickly that there is going to be what is called as the pay commission recommendations coming up within the next 6 months. All of the government employees of Indian central government as well as state government once in 10 years get a readjustment of their wages. Whenever this has happened previously in the last few decades, we have seen, and it's a big amount, by the way, at the aggregate level, fairly big. Whenever this happens, it leads to, once again, a big push towards consumption. So all of these measures would lead to, I would say, a fillip to consumption, and at the same time, maybe the government's expenditure towards the various infrastructure sectors could remain, slightly weak for another year or two. Yeah.
Thank you, Ajay, for that detailed response. Thank you, Vetri, Ajay, for your great insights. And thank you all for taking the time and joining us. Feel free to reach out to your UTI sales representative should you have any questions. Thank you.
Thank you.
Thank you. Thank you, everybody.